What we saw over the weekend when Iran attacked Israel was that Bitcoin actually went down. I don't consider Bitcoin to be a store of value. If we are in a period of time with geopolitical turmoil, then I think gold should vastly outperform Bitcoin. We are spending 1.1 trillion a year on interest payments. And the only solution is for the Federal Reserve to cap the yield curve, do yield curve control, if you want to call it, and directly monetize the debt. And that is how gold gets that parabolic move.
Hello, I'm Michelle Makori. Thank you for joining us. Gold has been hitting new all-time highs recently, topping $2,400 an ounce. Escalating Middle East tensions are now fueling safe haven buying, along with other tailwinds like record purchases by central banks and concerns over inflation, soaring U.S. government debt, and fiat debasement. And now some of the biggest banks are updating their forecasts, raising their gold price outlook by 40%. Citigroup is now calling for a $3,000 gold price over the next 6 to 18 months. Goldman is saying that gold is in an unshakable bull market, revising its year-end forecast to $2,700 an ounce. And UBS is now calling for a $2,500 target. Well, my next guest says that gold has the highest probability of a melt up since the early 1980s, and that the precious metal will outperform Bitcoin this year. Jared Dillian is a partner at Jared Dillian Money and the host of the Jared Dillian Show. He also works as an investment strategist at Malden Economics. Jared is the editor of the daily Dirtnap, a daily market newsletter for investors that has been running since 2008. And prior to this, Jared worked at Lehman Brothers, heading the ETF trading division there in 2005. And Jared, of course, is also a best-selling author. His latest book is No Worries: How to Live a Stress-Free Financial Life. Jared, welcome to Kitco. Good to have you with us.
Thanks. It's great to be here.
Well, Jared, I really enjoyed your book, and it seems we share similar philosophies regarding money and happiness. In fact, you made me feel pretty good about splurging on small things like my daily Starbucks coffee. We'll get into that later on in the show. But seeing as in your book, you say that the chair of the Federal Reserve is the most powerful person in the country and not the president, let's first get your thoughts on what we just heard from Fed Chair Jerome Powell. And Powell saying that the U.S. economy, while otherwise strong, has not seen inflation come back to the central bank's goal of 2%, pointing to the further unlikelihood that interest rate cuts are in the offing anytime soon. Powell saying more recent data shows solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning to our 2% inflation goal. Now, Powell was speaking to a policy forum focused on U.S.-Canada relations, and he said that while inflation continues to make its way lower, it hasn't moved quickly enough, and the current state of policy should remain intact. Quoting him here again, the recent data have clearly not given us greater confidence, and instead indicate that it's likely to take longer than expected to achieve that confidence, and that we think policy is well positioned to handle the risks that we face, adding that until inflation shows more progress, we can maintain the current level of restriction for as long as needed. So what's your read, Jared, on what we just heard from Powell?
I think that's pretty rational. Inflation actually bottomed about 8 months ago, and it's been going higher ever since. The last reading was higher than expected, came in at 3.5% on the headline. And, like I said, this is pretty rational. Inflation isn't going away. And, if you go back about 6 months ago, we did have a period of weakness in the data, which is what inspired Fed Governor Christopher Waller to give his speech, where he was saying that monetary policy was restrictive. This is back when real rates were about 3%, but inflation has come up now and real rates were only about 2%. And, you can make the argument that policy isn't restrictive anymore. So the one thing I would point out here is that the bond market is looking kind of interesting. Rates have come up a lot. Rates on 2-year notes are getting close to 5%. And we have these geopolitical risks specifically pertaining to Iran and Israel. And I just think there's a lot of this is a very asymmetrical sort of environment where the economy could sort of truck along for a while. But if we had, a regional war or something bigger in the Middle East, you would probably see rate cuts pretty fast. So 5% on 2-year notes actually looks pretty attractive to me.
Okay, so with the exception of Middle East war breaking out and escalating to a higher level, you think that the Fed is going to stay steady? What's your outlook in terms of Fed cuts then?
Well, if you go back to, I think, about December, we were pricing in a ridiculous amount of rate cuts. We were pricing in 6 to 8 cuts. And now the probability of a June cut is down to about 20%. I mean, if things stayed the way they are right now, then you might make the assumption that we're not going to have any rate cuts before the election. I do think we will have one rate cut before the election, probably right before the election itself.
As political a move as that would be deemed to be, considering that the Fed is supposed to be apolitical, I mean, surely that's going to come with a lot of pushback, saying that the Fed is playing into the Biden administration's hands if they cut right before the elections?
The Fed is, look, I have met some Fed officials over the years, and I've learned a little bit about how the central bank operates. And the Fed is not immune to politics. They're not impervious to politics. In fact, they're a lot more political than people give them credit for. So I do think one rate cut before the election is super possible. So,
right. What about a Fed hike? Because UBS is now saying that there's a real risk of the Fed hiking rates to 6.5% next year. There's a few murmurs that we could actually even see a Fed hike, perhaps not in 2024, but in the beginning of 2025. Any thoughts on that?
I think that's entirely possible if, we continue on the current trajectory for inflation, especially if oil prices go up. If we do have a war, you're going to have inflationary pressures globally. You could see oil get to $90, $95, $100 a barrel. I think in that case, you probably would see rate hikes, but it's kind of hard to see out to 2025. There's a lot of things that can happen. There's an election, there's geopolitical stuff. I think we got to focus on the next 6 months.
Yeah, fair enough. Too many known unknowns and too many unknown unknowns. So, Jared, you say that gold, though, has the highest probability of a melt up since the early 1980s. In your newsletter, you break this down, saying that commodities crash up, and it's quite possible that there'll be a parabolic move in gold and in other commodities. Break that down for us.
Well, I actually asked this on Twitter sort of rhetorically. I said, what if gold does what cocoa did? Cocoa went from 2,000 to 10,000 in the span of a couple of months. You get squeezes higher in commodities. Gold broke out of a 13-year consolidation. And what's interesting to me is, you mentioned the price targets being raised at these various banks, which is not really a good sign for sentiment. But the emails I typically get from people, my subscribers, they're saying, when do we sell gold? Like, when do we take profits? And I'm like, guys, like, we literally just broke out of a 13-year consolidation, and it's been going up for a month, and you're asking when to take profits. Like, that doesn't make any sense. Cocoa, by the way, was also a technical breakout. I mean, there were fundamental things going on, but it broke out of a 47-year base. So the longer the consolidation, the more impulsive the move higher, and the longer it's going to last.
But can we really make the comparison to cocoa with gold and cocoa? I mean, there were other factors, as you said, fundamental issues that saw cocoa surge. There were pro-harvests in West Africa, which produces the bulk of the global cocoa supply. You had certain weather patterns that led to dry weather in Ghana and Ivory Coast, two of the world's biggest producers of cocoa beans. You had supply chain issues. You had increasing demand for cocoa, general inflation. I get the technical analysis aspect, but can we really make that sort of comparison with cocoa making such a surge and gold making such a surge with those differing fundamentals?
Well, I mean, obviously they're two different commodities. They're going to have two different fundamentals, but the fundamentals of gold are potentially just as powerful. I mean, what we have is we are spending 1.1 trillion a year on interest payments. The US government is. If you go back to 2019, it was 300 billion a year. And depending on who gets elected, or maybe not depending on who gets elected, deficits are probably going to be larger in 2025 and 2026. So we're going to get to the point where interest payments are taking up a significant portion of the budget. And the only solution is for the Federal Reserve to cap the yield curve, do yield curve control, if you want to call it, and directly monetize the debt. And that is how gold gets that parabolic move. And I don't think this is going to happen imminently. It's not going to happen in 2024. But I think it is going to happen in the next presidential cycle. I think sometime between 2024 and 2028, we're going to have to make these decisions.
All right. So one of the factors that you're saying here is gold functioning as a way to counter debt monetization. So break that down for us in the timeline that you see this happening.
Well, the things in markets always take longer than it always takes longer than you think. So it could take longer, but debt gold. Let me back up a second. The one economic variable that gold is most correlated to is budget deficits, hands down. A lot of people think it's correlated to inflation. It's not. A lot of people think it's correlated to real interest rates. It's not. It's really about budget deficits. And you saw this back during the Obama administration. Gold skyrocketed from 2008 to 2011 when we were running deficits at 10, 11, 12% of GDP. Then in 2012, we got a Republican Congress. We had gridlock, and gold actually dropped from $1,900 an ounce to $1,050 an ounce. It's perfectly correlated with budget deficits. So the only reason you sell gold here is if you think that budget deficits are going to come down, that we're going to have some kind of deficit hawk in the White House or in Congress.
All right. And you've been tweeting about this, saying you wouldn't be surprised if we saw full-blown debt monetization in 2024 to 2028. That is the end game. What do you mean by full-blown monetization?
Well, so basically, we are dependent on low interest rates to finance the government. And if interest rates rise much further than they already are, so interest rates across the curve are a little below 5%, but if we had rates of 7 or 8%, then we would be functionally insolvent as a country. And that is when the federal government would apply political pressure on the Fed to peg the yield curve across the curve, which has been done before. I mean, this happened in the 1930s and the 1940s. We pegged the 30-year bonds at 2%. So this has been done before. So we would peg the yield curve, and the Fed would print money, an unlimited amount of money, to buy an unlimited amount of bonds at a particular point in the yield curve. So this has happened a couple times in history. Happened in Weimar Germany, happened in Zimbabwe. Argentina is kind of pushing back on this right now. But, this is, a lot of people aren't thinking about this. And this is something that could be in the next 5 years.
And you're saying regardless of who wins the elections, that any administration who wins 2024 to 2028 is the time period where you see this full-blown monetization?
I think it happens faster if Biden wins. Then I think it happens very fast. Trump is politically, he's not a small government Republican. The size of the deficit increased a decent amount while he was president. The pandemic didn't help. He did a lot in stimulus, but even beyond that, in discretionary spending went up. So neither of these two candidates are really deficit hawks. I just don't think we've gotten to the point where people really realize the extent to which the deficit is affecting their personal lives, and it becomes a political issue. When I was in fourth grade back in 1984, all anybody could talk about was the deficit. And the deficit back then under Reagan was pretty manageable. It was about 5 or 6% of GDP. Now it's about 7 or 8% of GDP, and it's an intractable problem. And as a political issue, nobody really cares about it.
So, Jared, what does that mean then in terms of the price of gold, if that does in fact happen? If it plays out and you have this full-blown monetization, what is gold at come 2028?
It's going to go a lot higher. That's pretty much all I can say. I do want to talk about the short term a little bit.
We definitely want to get your thoughts on the short term. But do you have a projection for 2028, like a rough range?
I don't want to make a projection. I don't.
All right, well, let's talk about the short term, because we have seen gold hitting new all-time highs, and now we have an added factor, which is this escalating tension in the Middle East, with Israel was going to respond to Iran's unprecedented assault of last weekend. We still don't know exactly what Israel is going to do, but it has made it quite clear that there will be some kind of retaliation at some point. Markets, for the most part, aren't really moving on that right now. So what do you make of the very short-term movement that we can expect in gold?
Yeah, you mentioned what's going on in Israel, and as you know, commodities generally top around geopolitical events. All the price targets being raised kind of concern me. I don't think that gold is getting to 27 or 2,800 this year. I think it's going to top in the short term. I think we'll have trend exhaustion sometime in the next 2 weeks, which will happen at some point in the 2,500s. Now, me personally, 40% of my net worth is in gold. It's an enormous position. And sometime in the next 2 weeks, I plan to fully hedge that position. I'm going to hold the position, but I'm going to fully hedge it because I expect about a 10% correction.
So you see gold hitting 2,500 and then a 10% correction from there?
Yes.
As people take some profit off the table, what would make that 10% pullback happen?
You never know why trends end, but I really focus on sentiment. Sentiment has been getting a little bit hotter. Gold people, including myself, have been a little bit more bullish on Twitter. I think what you'll see is sort of an exhaustion of bullish sentiment in the short term, and then a price pullback. And then you can, I think it could pull back to as much as 2,250, 2,300, at which point I think it would be time to buy again. So do you have a support level from a technical analysis point of view that you're comfortable seeing gold hold? Even with this pullback? 2,250 for sure. Yeah.
2,250. And at that point, you're getting back in and buying that pullback. Jared, in one of your latest newsletters, you make the comparison to gold and Bitcoin. And you write that we've entered a period of time where gold will actually outperform Bitcoin this year. What is underpinning your conviction there? Break that down for us.
Well, it's happening as we speak. So gold is up 10% in the last month, and Bitcoin is down 10% in the last month. And if you look at a chart of gold, the gold ratio over Bitcoin, it's been going down relentlessly over the last couple of years, and it's kind of made a double bottom, and it's turning higher. So just from the technicals, I think gold's going to outperform. But we saw over the weekend when Iran attacked Israel was that Bitcoin actually went down. I don't consider Bitcoin to be a store of value. I'm not really sure what it is. I think it's sort of a bet on technology or innovation or cryptography or something like that. I don't consider it to be a true store of value. So if we are in a period of time with geopolitical turmoil, then I think gold should vastly outperform Bitcoin.
Only if there is a geopolitical turmoil that leads to a major Bitcoin sell-off.
Yes.
Because, if we look at Bitcoin currently trading at around 62,000, as you mentioned, not really functioning as a safe haven in response to the Iran-Israel news. It is up, though, around 48% year-to-date. Spot gold is trading at just below 2,400. up around 15.5% year to date. But if gold were to rise from here to $3,000, which is a slightly more than the conservative estimate, that's a 26% increase. The conservative estimate that many of our guests have given us for Bitcoin this year, as well as many of the big analysts at the major banks, is that Bitcoin could hit $100,000 by the end of 2024. And that would be a 60% increase. But that's not the scenario that you see. You see Bitcoin dropping drastically, but only if there's a big geopolitical upset.
Yeah, I mean, look, flows into Bitcoin because the ETFs have just dramatically increased the price. That particular financial innovation, the Bitcoin ETFs, allowed a lot of people to put a lot of money into Bitcoin, and we got to run from about 49,000 to 70,000. I think that's pretty much over at that point. Those flows are tapering off. So yeah, that's the basis of my call. So.
All right. Well, still to be determined if the spot Bitcoin ETFs in the US are indeed tapering off. But what about flows from other ETF markets like in Hong Kong and South Korea, for example?
What do you mean? I haven't heard about this.
Okay, well, Hong Kong has just conditionally approved spot Bitcoin ETFs as of April 15th. South Korea is looking at doing the same. So you've got spot Bitcoin ETFs opening up in Asia and other markets, arguably creating even more new demand.
Oh, I didn't know that. Okay.
All right. Well, you have to watch Kitco for the latest Bitcoin and the latest gold news. And of course, we've also got the halving event. But I get it. You're not a fan of Bitcoin. You do not see it as a store of value asset. In fact, it's an interesting point that you make in your book that for you, Bitcoin is a very stressful asset. And in your book, you're all about minimizing financial stress. And you said that you find Bitcoin far too stressful an asset for you in the quest for happiness and minimizing financial stress there.
Yeah, I mean, Bitcoin has a pretty good return, but something that has a lot of return also has a lot of risk. And if I have an asset that returns 8% a year with a historical volatility of 20, versus an asset that returns 15% a year with a historical volatility of 100, I'm going to take the less volatile asset. It's really what I don't know if you want to talk about the book right now, but that's really what the book is about, is minimizing your financial stress. What's funny is if you add Bitcoin to any portfolio, it makes the Sharpe ratio go up. But that's really only because it's been going up ever since inception. If we ever had, never mind. I hate talking about this.
You hate talking about Bitcoin or what? Go on, finish that thought.
Well, what I was about to say is if we've ever had a true bear market in Bitcoin, but we have had a couple of bear markets in Bitcoin, but not ones that have lasted for a decade or more. So.
Right. Well, we haven't had a Bitcoin bear market that's lasted 10 years because Bitcoin has only been around less than 2 decades. And some people say that, in fact, it's riskier to not have any exposure to Bitcoin than to have exposure to Bitcoin. But perhaps you can come on and challenge one of our guests that are big Bitcoin proponents or Bitcoin maxis. We'll save that conversation for another time. But for now, as we're running out of time, let's get more of your thoughts on your book. And you say that the source of financial stress is, in fact, risk and debt, that those are the two primary sources of financial stress. And you aim to minimize financial stress in order to be happy. You say that the goal isn't to be rich, the goal is to be happy, though if you're doing it right, you can probably have it both ways. And you say that most people believe that the antidote to financial stress is more money, but it's not. A stress-free financial life is a function of how you structure your financial affairs and your attitudes towards money. And you cover both in the book. And you also say that there's a fallacy in the personal finance discipline that having money is the product of a million small daily decisions. In fact, you're right. I like this line. The greatest lie ever told: you can get rich by cutting expenses to the bone. Austerity is tough. It's tough to maintain day after day, week after week, month after month. And it's even tougher to maintain over 40 years. This program that you're signing up for, denying yourself simple, common luxuries that everyone else has for an entire lifetime, is too hard. Yes, some people do it and they do it successfully, but it results in unnecessary suffering and deprivation. and most importantly, distorts your relationship with money. And you say that if you get the big decisions right, then you don't have to worry about the small decisions. So break that down for us.
Sure. Here's the book, No Worries, How to Live a Stress-Free Financial Life. Um, a lot of the personal finance literature in America is obsessively focused on cutting small expenses, like standing in the grocery store and trying to figure out the cheapest can of soup or not buying coffee on the way into work. The accumulation of small decisions does not add up into anything big. It's really meaningless. There's three things you have to focus on: the house, the car, and the student loans. Buying a house is the riskiest financial decision that you will make in your life. It could go well or it could go poorly. So if you get it right, you don't have to worry about not buying coffee on the way to work. Buying a car is a slightly smaller financial decision, but if you do that wrong, it can cripple you. And student loans, we all know what's going on with student loans. So those three things, and you get those three things, and you don't have to worry about the little stuff.
Right. You certainly made me feel a lot better about indulging in my morning coffee because, as you say, you have lots of personal finance experts like Susie Orman, even Mr. Wonderful Kevin O'Leary gives people a hard time for buying coffee rather than making it at home. But you make the point that money is about making your life easier, is about making yourself happy, is about lubricating your daily existence and not necessarily exceeding your means and not necessarily living below your means. And you have an interesting chapter in the book where you talk about the, CFs. I'm going to let you tell our viewers what that means, as well as the high rollers and how this trick is having the right attitude and finding the balance between the two, the cheap Fs and the high rollers.
Yeah, well, I mean, there's basically the way I see it is that there's only a very small percentage of people in the United States that have what I would call a healthy relationship with money. And you have a healthy relationship with money when you don't think about it all the time. Now, I don't really mean in the context of your job. I publish a financial newsletter, so I have to think about money all the time. But in terms of my personal financial well-being, I don't think about money. I have a healthy relationship with money. If you are cheap, if you are a person who is really cheap, or if you know somebody who is really cheap, and I'm sure everybody knows somebody, this is a person who is obsessed with every single expense and they're thinking about money all the time. If you have a person that spends a lot of money and they go deep into debt, they have a lot of credit card debt, they have car loans, they have tons of debt, they're obsessed with the debt, they're always trying to make the next payment. These two characters, the CF and the high roller, have an unhealthy relationship with money. The goal is to have a healthy relationship with money.
And you give a lot of tidbits in the book about having the right attitude towards money, about how important it is that you find a partner that shares the same relationship to money as you do. So I really recommend our viewers check it out. It was actually a very fun read. Before we let you go, let's quickly touch on the awesome portfolio. Because you just mentioned that you have 40% in gold, but in the book you say the ideal portfolio should have stocks, bonds, cash, gold, and real estate. And I believe you break it down into 20% each in the awesome portfolio. Is that still your outlook? Is that what you would suggest for people depending on their risk profile? But is that the general breakdown of what you think should be the awesome portfolio?
Yeah. And a lot of people ask me why I have, because 20% gold seems like a lot for people. Even, most people don't have gold. Some people have 1% or 3% or 5%. 20% seems like a lot. But gold is what I call the Dennis Rodman of asset classes. Let me explain what that means. Dennis Rodman is in the Hall of Fame, basketball player. He didn't score. He only scored like 6 points a game. And there was a big discussion about whether he should even be in the Hall of Fame. But what he did was he rebounded and he passed. Now, if you had a team full of Dennis Rodmans, it wouldn't be a very good team because it doesn't score. But if you take Dennis Rodman and you add him to a team of players that can shoot, then it becomes the best team in the league. And that's the role that gold plays in the portfolio. Gold is not correlated to anything. Its correlation to stocks is weak. Its correlation to bonds is weak. And because it is not correlated to anything, it brings down portfolio risk. So whenever you add gold to a portfolio, you make the risk characteristics better and you bring down the volatility of the portfolio. And if your portfolio is not volatile, then you're happy, then you're not stressed, then you can sleep at night.
All right. Well, I think the book helps people sleep better at night, so I recommend it. Thank you so much for your time, Jared Dillian. Really appreciate it. Thank you.
Thank you very much. Thanks.
And as always, thank you to our viewers for watching. From me, Michelle Makori, and the rest of the Kitco team, make sure to subscribe, and we'll see you again soon.